Hello. Well, we're going to start talking about the accounting information system, talking about some of the um, rules and regulations, some of the guidelines that we follow for uh, creating financial statements. So, we're going to discuss financial reporting concepts. We're going to analyze hold on, I need to set my timer here. um, okay, so we're going to analyze business transactions. Okay, so we're going to review how they're recorded in the accounting system. So, what we're doing again is what do? We collect information, we classify the information, and we put it into a form that people can use to make informed decisions about whether they want to invest in a company or loan money to a company. So, what is revenue? What is an expense? What is an asset? Well, these are terms that have to be defined, and they're defined by the standard setting environment called Generally Accepted Accounting Principles, GAAP. And GAAP is very important for public companies because they have to comply with generally accepted accounting principles when they prepare their financial statements. And so it will again tell accountants how to classify things. There is a website generated or operated by the Financial Accounting Standards Boards, FASB. And if you need to know, well, how do I record assets? You can go there and it will have assets and it will further break it down into cash, what is considered cash, what is considered cash equivalents, etc. So these are a set of rules and practices having substantial authoritative support that companies use to determine what type of financial information to disclose, what format to use, how it should measure assets, liabilities, revenue, and expenses. Yeah, how do you measure these things? Now, for a public company, though, if you want to become a public company, and all public companies are C corporations, then you have to go through the Securities and Exchange Commission and you must follow their rules and regulations. So the Securities and Exchange Commission is the overall body to determine how you should act, what types of statements that you should produce. If you want to provide information to the public, how do you do that? And they're the ones that set those rules. Okay. And they tell you that your financial reports must conform to GAAP, generally accepted accounting principles, and that is controlled by the Financial Accounting Standards Boards, FASB. Now, the Public Company Accounting Oversight Board was created after 2001 when there were a significant number of um, financial fraud. And so the Public Company Accounting Oversight Board really monitors public accounting firms that do audits. So this is for the US, but for the world, you have the International Accounting Standards Boards. Now, there are a lot of things are similar, but there are some differences. You know, international note over 115 countries use international standards, which is good because then you don't have to worry about, well, one country does it different than other countries. I mean, GAAP is considered probably, some of the best accounting standards in the world. But not everyone wants to use the way that America does it. So you can see that we use FASB, but a lot of these other countries use International Financial Standard Reporting Standards. So, generally accepted accounting principles are a set of standards and rules that are recognized as a general guide for financial reporting. That is correct. So, qualities of useful information. So, how do we determine if information is useful or not? Well, number one, we have relevance. Accounting information has relevance if it would make a difference in a business decision. And it provides information that has predictive value so that you can look and go, well, what do I think is going to happen next year? What are the trends? It has confirmatory value. And now materiality is something that is prevalent or important in accounting. If you have a company and they made $2 million and they made a mistake, so they overstated their income by $1 million, that is significant. That's material. If you have a company like Walmart that made $15 billion, $1 million, is that going to make you change your decision about whether to invest in Walmart? And the answer is no. So materiality is relative to each individual company. Faithful representation. Hey, the financial statements really represent what happened. All right. It's neutral, it's free from material error. And one of the big uses is comparability. So we want to be able to compare across country companies, across industries, so that we can determine and make useful decisions. Do I want to invest in Google or Alphabet, I guess, really? Or do I want to invest in Microsoft or Apple? And so I want to make sure that revenue is revenue and expenses are expenses, etc. You have consistency. They use the same accounting principles year in, year out. In some cases, you have a choice. But as long as you make an informed decision about what you're going to use, and you don't change it just to make your financial statements look better, then it's okay. But you would like to be consistent. And so that's why sometimes when accounting and FASB changes how they record revenue, you have to go back and restate earnings to go, okay, had we adopted this type of reporting, here's what our financial statements would have looked like. Verifiable. Um, an independent observer would agree to your financial statements. Now, one thing in accounting is there are a lot of estimates. Not everyone is going to agree to those estimates, but as long as your auditors agree and you have a good basis for the way that you record things, then it should be verifiable, timely. If I don't produce financial statements until 6 months later, is that useful information? Is that timely information? 6 months has passed. Things have probably changed. And then understandability. All right. And that's why when you provide these financial statements, you need to do it in a way that people can understand it. When you provide your projects and the financial statements, you need to format it so that it all fits on one page, so that it doesn't make it difficult to go, that you have part of the information on this page and part on that page, and it makes it difficult to go back and forth. Monetary unit assumption just means that, well, you have to record something in some currency. So for the US, it's dollars. So for US based companies, you have to record things in dollars. And if you have a subsidiary, let's say that you have a German subsidiary, well, they're operating in Germany, so most likely they're going to record things in euros. But when you make your financial statements and prepare your financial statements, you have to convert those euros to dollars because you will not really understand. You don't have a feel for euros. You have a feel for dollars. kind of probably have a feel for what $1 billion uh, is worth. But €1 billion, well, I guess you can do a translation. But anyway, everything's got to be converted to the same currency. Economic entity assumption states that every economic entity can be separately identified and accounted for. Public companies are separate entities. So you have they're like a person. They can enter into contracts. They pay taxes. So you can identify them. You know, you have Ford, Kia, GM. All right. Periodicity. We produce in the U.S. quarterly and yearly financial statements. Your company probably will produce monthly financial statements because your company wants your managers to be able to make adjustments quicker than just on a quarterly basis. And going concern assumption. We're assuming you're going to be in business. But if an auditor comes in and they don't think that you're going to be in business, they will record that. Now, think about if you owned a stock and the auditor said, we have concerns about whether this company is going to be in business. Would you want to own that stock any longer? Probably not. All right. So those are overall guidelines, measurement principles. We measure everything at historical cost. Well, most things. So if we buy an asset, we're going to include all of those costs to make that asset ready for its intended use at its intended location. But if we get a rebate, that means that we have a lower cost than we would have had. We'll include that. So we want to record things at what it actually cost us. So it's not like, well, we're going to record the cost, but we get this rebate. We're just not going to factor that in. We'll just take the rebate. And that's not how it happens. Fair value. There are some things that are recorded at fair value. If you own stock, the stocks are normally on a quarterly basis, or when you produce your financial statements, they are um, put on the or they are recorded at fair value. So that's part of that. Other comprehensive income will include the change in that fair value. Also, if you buy a company, you get to mark those assets up to fair value. It's really the only time you get to do that. Full disclosure. If you look at a financial statement, it's got your financials, but then it's got a lot of notes. Here's how we do depreciation. Here's how we record revenue. Here are the number of leases that we have, etc. Cost constraint. Information is useful, but you don't want to spend so much money producing the information that it's just not cost effective. So you do have a cost constraint. So here are the items that FASB, when it creates accounting standards, so they take all this into account when they create a standard. Each item with the appropriate concept or principle, ability to easily evaluate one company's results relative to another, comparability, I'm thinking. Belief that a company will continue to operate for the foreseeable future, going concern. The judgment concerning whether omitting or misstating an item could influence the decision of a financial statement user, materiality. The reporting of sufficient details regarding circumstances and events that would make a difference to financial statement users. Full disclosure, okay. Practice of preparing financial statements at regular intervals, periodicity. Quality of information that indicates that the information makes a difference in decision relevance. A belief that items should be reported on the balance sheet at the price that was paid, cost, historical cost. A company's use of the same accounting principles and methods from year to year. Consistency. Okay. Tracing accounting events to particular companies. Let's see, what is that? Economic entity. Desire to minimize errors and bias in financial statements. Faithful representation. Reporting only those things that can be measured in dollars. Monetary unit. And getting back to the monetary unit, yeah, you have to be able to measure it in dollars. So you can't put things on your financial statements that you can't measure. What is the primary criterion in which accounting information can be judged? I'm thinking usefulness for decision making, and that really is the criteria here. All right, so I'm going to break this into two videos because now we're going to actually go through the nuts and bolts and talk about how things are recorded.